What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF, and we're also going to talk about the CPI report, which is expected this Tuesday. This report will either make or break the market, so make sure you pay attention to the levels we give you, because above certain levels, the market can really take off, and below certain levels, we can severely sell off. The next thing we're going to talk about is going to be some stocks that we're watching for the weeks ahead. We're also going to give you some important resistance and support points that will guide you in terms of price targets and stop losses. So there's going to be a lot of information in this video, but we're going to start off by talking about the overall market. So first, let's talk about the levels that are key on SPY for the week ahead. Last week, we saw SPY pull back to its 20-day moving average, which is on the daily charts. We can see that the last time we pulled back to the 20-day moving average, the market ended up rocketing higher and we rallied for 2 weeks more. So this time around, a lot of people are wondering, are we going to bounce off the 20 and continue our push towards 420, or are we going to sell off below the 20-day moving average and start declining towards the 50-day moving average right around the 395 support? So going into the weeks ahead, make sure you pay attention to the 10, 20, and 50-day moving averages. If we're trading above those levels, that means the market can push higher. If we're trading below the 10 and the 20, then we can fall to the 50. And the 50-day moving average is usually a good determinant as if we're overall in a bullish trend or overall in a bearish trend. So you do not want us to move back below the 50-day moving average because we are likely to sell off and move towards our 52-week low in that sense. And so looking at the shorter term charts, if you're not so worried about the daily charts, if you're looking at the intraday charts, you're going to be focused on these pivotal levels. First of all, 400 remains a very strong psychological support. It took us forever to get back above 400, and so it may take us a while to get below 400. But the moment that we do get below it, we can see panic selling get induced, and everybody that bought the market up above 400 can sell it back down towards that 52-week low. So there's a lot of reason to believe that we can move back to the 52-week low, but it all depends on the outcome of the CPI report. So for the last 7 months or so, the CPI report has been showing that inflation is cooling off. Inflation has been the number one battle for the markets in the last 12 months or so. And so if inflation is expected to cool off further, then we do not want to miss that target. Because here's what happened in last week's the Federal Reserve meeting, which is called the FOMC. Last week, we saw the Federal Reserve only raise interest rates by a quarter point, which is 0.25. And so they are taking a less aggressive approach, hoping that inflation is indeed cooling off. But when we look at the US Consumer Sentiment Index, we see that it's been going up, and retail sales are expected to move higher in this week's report. So this week we have two reports. One is retail sales and the second is CPI. Last week we got the consumer sentiment, and so we are expected to see higher figures considering consumer sentiment also came in higher. And so if we see higher retail sales, then it can point to the fact that inflation may be starting to pick up again, but we will be getting an update on inflation on Tuesday. So we are still very much at risk of a sudden spike in inflation because consumers are happily spending still. A lot of people are still spending those dollars and creating demand, and the more demand we have, the higher prices will go. Therefore inflation will start picking back up again, and if inflation starts to pick up again, we will definitely have a severe sell-off on the stock market. So make sure you pay attention to those numbers. The expectations is 6.2%, so we are expected to improve from last month's 6.5, so we need to hit 6.2 or below. Now keep in mind, if we hit 6.2 or below, it does not guarantee us to completely take off. Of course, cooling inflation is good for our economy, but it doesn't necessarily mean the market will just take off. It may have a good positive reaction initially, but pay attention to levels. Never trade news. You want to trade levels, which is why we're giving you these levels here. So if you are going to trade levels in the CPI report, then you're going to first focus on the 400 as we spoke. If we break below 400, then these are the support points that you want to focus on next, including 387 or 387.50. So right around around 387 would be another support that you need to focus on if you are looking to trade to the bottom side, or if you're looking for a point to cut your bullish positions. Now, if you are bullish, we need to move back above 410, which is the first pivot point to focus on. 410 was a point in which we got rejected and sold off severely in the past, and the fact that we made it back above it in the last 10 days was a good sign. But as of Friday, we sold off. You can see that we sold off all of Thursday, and then Friday we barely managed to move back into that sell-off range. And so the reason why we sold off was that the market was expecting the consumer sentiment report to go up. If consumer sentiment is up, remember, it creates demand, which will increase inflation. So people or investors ironically are scared of an expanding economy right now because it could mean that inflation will pick back up. And so if you are bullish on the market and we move back above that 410 level that we managed to hold above the last 10 days but broke below last week, if we break back above 410, then we are expected to push towards 415 and then 418.30. 418.30 is our most recent high that we couldn't break above, and so if we break above that level, we can see a move finally above 420. So the next section of our video is dedicated to our watch list. This week we're coming out with a little bit of a shorter watch list than usual, but that's because we're expecting the CPI report, and our watch list from last week is still valid. So if you want to rewatch that video and have that watch list, you can do that too. But for this week, we are just watching 3 stocks to start, and then after Tuesday's report, we're going to be looking at a lot more stocks, and that's because we want to see what the CPI report brings, and then we want to play the reaction accordingly. Playing anything into the CPI report is a pure gamble because the market is very much likely to either gap up very highly or gap down very strongly. So keep that in mind if you are trading and swinging into the CPI report date. So the first stock on our watch list is going to be Pepsi, or PEP. This is a company that just beat earnings on both revenue and earnings per share. So anytime a company is beating earnings during a time in which the economy is in question, that's a good sign, especially when all of tech, most of technology stocks, including Apple, missed earnings expectations. However, you have here Pepsi, an old giant, a trustworthy giant, beats earnings, and they have been selling off for quite a while. So it is time that people start looking at this stock again. We can see that they came out of what was a box consolidation that they held for over a month, and finally on earnings they broke above it, came down to retest it at 172, but managed to push back up on Friday. So going into this week, these are the levels that we're watching on Pepsi. We're going to start by looking at the 176.55 resistance. If Pepsi can break above that point, then we can see it moving towards 179.40 and 182.40. So give or take a few pennies on those price targets and start taking profits as soon as it reaches these points above this point. So if Pepsi breaks above 176.55, then you can place a stop loss just below that level because that resistance will turn into a support, and you can just ride it up towards 179.40, close half, and then update your stop loss from this point to this point, and then ride the other half and then take profits somewhere around that point. If Pepsi breaks below the 172 level, that's not a good sign at all because the company just broke above this 1-month consolidation. So if we see bears take it back down below 172, then we can see a sharp sell-off towards 167. And if you play puts, you would treat it exactly vice versa of what we talked about here. You would play your put or your short position here, place a stop loss just above 172, and then so on and so forth. Take half here, update your stop loss, and take the other half. Now you have the choice of playing the breakout at 176.55, or you can see if Pepsi gives you a pullback to 172, where you can enter here, place a stop loss below 172, and then ride it back up if it gives that pullback. It's not guaranteed to give that pullback. The next stock on our watch list is going to be Starbucks. Now, Pepsi, we are leaning more bullish. Starbucks, we are leaning more bearish, but we're willing to play both sides. The reason why we like Starbucks for puts is because they just missed on earnings and they just paid out their dividends. So there's not really a real reason for quarterly position traders to be holding this position anymore because they've already gotten paid on their dividend and they already saw bad earnings from the company. So right now could be a time where Starbucks is trading back below its 10 and 20-day moving averages. It's back to retest the 10. So if you are looking at the daily candles, which you should be checking at the top of every day, so every day that the market opens, the first thing you should watch is the daily candles because you want to know where did it open. If it opens above the 10-day moving average and the 20-day moving average, then you can turn those points into a support point and place a stop loss just below them if the stock dips back below, and you can ride it back up. Here are some levels that we're watching on Starbucks for the week ahead. The first level being 107.40. So we're going to show you how Starbucks here got rejected at 172.40 twice, which is called a double top pattern. You can see one rejection here and one rejection here. So if the stock fails to move back above that point, then it is expected to move back towards 105. If it breaks 105, these are the price targets to the lower side. Now, where would be your entry in this case? You can either enter right here where it's at and place a stop loss just above 172.40 because that's the point in which bears don't want the stock to get back above in order to avoid a big breakout, and then trade it back down. Your first price target would be 105. Or you can wait for the 105 break and then trade it towards 103. If you decide to take a bullish position on Starbucks instead of a bearish position, you want a breakout above 107.40 for a price target of 110 to 111. Last but not least, the final stock on our watch list is going to be Walmart. So Walmart on the daily chart shows a very strong double bottom that happened right around its earnings lows. So when Walmart reported earnings, we can see that they strongly gapped up and then rallied for 2 weeks after. Before that gap up, they came down to a low of right around 138, in which they just retested once and twice. So now this is what we call a double bottom, or if we include this support bounce, we call that a triple bottom. A triple bottom bounce is typically a bullish reversal that can happen at a specific point, in this case being 138. So when we're looking at Walmart and we're creating our levels, 138 becomes the most critical support point that they need to hold. If they hold above 138, we will be bullish on them, and we're looking for a breakout above 145.65 for it to continue moving to the next price targets, which are labeled up here. If Walmart loses the 138 support, that's a very bad sign because this is a point in which buyers said that they're not going to sell below once, twice, and 3 times. So if they finally say, okay, we're going to let go below 138, then the stock is expected to fall and likely experience some panic selling all the way down to the low 130s. So that's all for the week. We really hope that you guys enjoyed this video. Please don't forget to subscribe and give us a thumbs up. Thank you so much for your time and best of luck.